Fixed Income Market Outlook April 2023. Inflation and rates, RBI commentary keenly awaited. India remains a key beneficiary from falling oil prices. The ripple effects of low commodity prices are likely to help soothe inflation in the latter half of the year. Domestic CPI for the month of February stood at an elevated 6.4%. Initial signs of an inflation cool-off have been witnessed in the US, with inflation core PCE falling below 5%. Prices of timber and the metal complex have already retraced to pre-COVID levels, signaling a stabilization of prices in the aftermath of global supply chain issues. RBI comments post-policy on 6th April are likely to be triggers for market movements for the month. MF taxation change, life after 31st March doesn't change much. The Finance Ministry made some surprise amendments to the Finance Bill 2023 before passing it through both houses of Parliament. Amongst them were removal of LTCG benefits from select categories of mutual fund schemes. For investors, while the new taxation structure may seem detrimental in the near term, the market-linked nature of the products and single-point taxation at the time of redemption make debt mutual funds relatively attractive as compared to comparable fixed savings instruments. Positive comments from the US Fed. The US Fed raised rates by 25 basis points as expected. The commentary, coupled with tightness in system liquidity due to the banking crisis, was seen as indications of a pause or peaking interest rates. US bond yields dropped significantly through the month, with maximum gains coming in the 2 to 4 year segment, 75 to 80 basis points drop. Positive inflation data trends make the case of incrementally stable rates stronger. Market view. The current curve remains very flat, with everything in corporate bonds beyond 1 year up to 15 years is available at 7.5 to 7.80% range. We expect the curve to remain flat for most part of 2023, with long bonds trading in a range for most part of 2023, 7.25 to 7.75%. Falling CPI, weaker growth and strong investor demand would keep yields under check despite high G-Sec supply next year. We retain our stance of adding duration to portfolios in a staggered manner, given that a large uncertainty driving rates and duration calls in now out of the way. For investors with a medium-term investment horizon, we believe the time has come to incrementally add duration to bond portfolios. For investors 3 years plus investment horizon, incremental allocations to duration may offer significant risk-reward opportunities. Spreads between G-Sec AAA and SDL AAA have seen some widening over the last month, which could make a case for allocations into high-quality corporate credit strategies. Lower-rated credits with up to 18-month maturity profiles can also be considered as ideal carry solutions in the current environment. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.